Hello, agents. Hello, everyone. So today I'm going to take a look at guaranteed lifetime income with inflation protection. It's called cost of living adjustment on immediate annuities. And we're going to see how that works out and why most people, once they see the pricing, decide not to go with the COLA, because of the huge difference in the pricing and the time to break even. So let's just jump right into this. And is it really just for the wealthy people? So we're going to look at this cost of living adjustment. We're going to assume the client is going to buy $1,000 a month and have that increase at 3% annually for life. It'll increase for life. So here's the pricing for a male age 60 and 70, female as well. And we're going to use life in 10 and life in 15. And of course, the way that works is, right, it'll pay no less than 15 years, but life, or no less than 10 years, but it will pay for life. So if someone dies in the 5th year on a life in 15, it'll still pay for 10, but if they're alive in 100, it continues to pay. So that's how that works, right? And the cost for that, let's just focus on the male for right now. The life in 10 would be, with 3% COLA, is $227,000, right? And the life of 15 is $230,000. So a small increase there. I'd strongly suggest always, for a small amount of money, buying that extra 5 years of income. And you can do the math on that later, but so that's how much it costs. Now let's back into it. Let's say you took that $227,000 and just wanted to buy an income that doesn't increase, right? Which is what most people want to know, is like they want to maximize their income. So that's going to kick off $1,380. So that's $380 more a month to start on that same person. So when you look at that immediately, unless you're really trying to plan $1,000 a month is your budget and you can afford whatever it costs. Otherwise, most people are looking just to maximize as much income as they can. So let's dive into this a little more. So let's say you wanted to take, that person just wanted to price it out. So this is, you get $380 more a month if you use the same premium, but say you just wanted to buy the same income of $1,000, right? So these are the ones we're matching off. So $1,000 a month on that same person would cost $164,000. So $62,000 more for the COLA. Right. So if they wanted $1,000 a month, they could pay $164,000, right? And that $1,380 a month is $16,500. So this person up here, right, this 60-year-old male that's getting $1,000 a month compounding at 3%, right? That is going to take $12,000 a year before it equals $16,560 is 11 years. So it's 11 years before they got the same payment as the person that just took the no COLA, right? But that's not really the break even, because the break even also has to add in what the money they miss. So the first year, every month they miss $380, and the second year a little less and a little less. So how does that break down, and where is the actual real break even for this person? And I think this is why most people are not going to do it, because it's so far down the road. And here it is. It's 22 years before all these payments. So it starts at $12,000, $1,236. And as you can see, it runs down all the way. You can pause the screen to look at those numbers. But after 22 years, the COLA side will now have $366,000, whereas the just flat even payment with that same premium of $227, that kicking off that $1,650 or that $1,380 a month, right? It's at $364. So somewhere in that 22nd year is the break even, right? So now that 60-year-old is 82 years old before they're actually going to get the benefit of the income, even though the income's coming in at much higher at $22,000 a year, right? It's going to help them that way. But overall, the money lost and the time value of that money, assuming they didn't even put the extra money into something that earned interest, right? So this is why most people don't take the COLA. It's a real longevity product. So if you live to 90, if this 60-year-old is to 90, it really does pay off. But it's a long-sighted, it's a long play to get out that far. So again, looking at the same exact thing, 3% COLA, you're going to get $1,380 a month if you don't use the COLA, right? And it's going to cost you 38%, or about what was the number there? $160,000, $164,000 to buy the same income, right? And what could you do with that extra money in the time? So anyway, that's kind of a breakdown. Here's some disclosures. That's the end of my presentation. But in the end, that's why I think it's really for people who just have the money and they're really trying to build a plan. So it's really for people that want to build a plan. You have plenty of money. I want to build in say a $5,000 a month income and have it increase, and that should offset my bills going forward. But for the regular person that's just trying to, hey, I want to turn this into a lifetime income that's going to be something, I'm not sure how long I'll live, I don't know what my health will be like in 22 years. That's why a lot of these people just purchase the non-COLA amount. So the COLAs are very expensive, but boy, do they pay off if you live long enough. So remember, SPIAs are a longevity product and all that. But hope that pricing kind of helps out and explains how that all works. And thanks for watching. Hope you have all a good week. And if you have any questions or comments, give me a call. And for the most up-to-date, be sure to follow me on LinkedIn and YouTube, and you'll get all that information and set those notifications up if you're interested. Thanks for watching.